Hello, welcome to today's economics podcast on fiscal policy, which we've started studying and we'll study a bit more of in the coming weeks after half term. Firstly, the definition of fiscal policy is government taxation and spending to influence the economy. Very important not to get mixed up with monetary. So if it's anything to do with the exchange rates, the interest rates and quantitative easing, that's monetary policy. Fiscal policy, government, tax and spend are the key words. Also want to just go through, there's quite a few definitions in fiscal policy. I'll sort of do them bit by bit. Words you should have heard definitely in the last few years: a budget deficit. So a budget deficit is how much a government has spent over its tax receipts in 1 year, and the national debt. The national debt is all of the budget deficits added up. So it's all of the money that the government owes. So this government and previous governments from all times. The deficit at the moment in the UK is coming down. So it was as high as 9, nearly 10% about 10 years ago. It's now around 3% of GDP. But because it's still a deficit, the national debt is going up. So the deficit is falling. It has been being cut. The national debt is still rising. The national debt won't fall until we have a budget surplus where tax receipts are higher than government spending. Another word you would have heard of in the news in the last few years is austerity. Austerity is the phrase used for governments cutting spending and increasing taxes to try and sort out the budget deficit. So a lot of questions are focused on, has this been correct, or how would they do it? Another question people often ask is, where do governments get their money from? So if governments do have this deficit, they're spending more in a year than they're taking in tax, where do they get the money from? The answer is in government bonds. Government bonds are essentially an IOU, a loan from individuals, financial institutions, insurance firms, pensions, banks, businesses. So you can buy a government bond of varying amounts. So say you've bought a government bond for £500. The bond would say the government will pay you back in 10 years' time plus 0.5% interest. So that's obviously a downside of the government having to borrow. Like all borrowings, it has interest on it. So at some point, the money's got to be paid back with interest. Other often asked questions in the exams are the mix of taxes that governments collect. So we've got a direct and indirect tax. Direct taxes are taxes on your earnings or income. So the big ones there are income tax on individuals and corporation tax on companies. And indirect tax is a tax on spending. So the biggest indirect tax is VAT. So some current rates and things happening with those at the moment. Income tax has been changed quite a lot in the last couple of years. You've now got a higher tax allowance, up to £12,000 at the end of the financial year, I believe. So that means the first £12,000 you have is untaxed. It's then a progressive tax, so it goes up in sort of staggered boundaries, where then the next lot is taxed at 20%, then the next lot at 30%, then 40%. The current government lowered the top rate of income tax, which is any earnings over £150,000 to 40%. It was at 50%. In terms of VAT was 17.5% in 2010. It is now 20%. There are varying arguments for and against which taxes should be used, which are better. VAT is a regressive tax, meaning it hits the poorest more. So as a percentage of income or earnings, VAT hits poorer people more than better off people. VAT is, however, very easy to collect. So a lot of the items people are buying are relatively inelastic in demand. People are always going to spend money, so you will collect, makes collecting that tax quite a lot easier. With the arguments for especially things like income tax and corporation tax to lower them are that it provides an incentive. So if you lower corporation tax, there is an incentive for firms to invest because they get to keep more of their money. If you lower income tax, it provides people an incentive to go to work, a supply-side policy, because you get to keep more of your money. With income tax, another argument about using income tax and corporation tax is that these are easier to avoid. So you would have heard of Google, Amazon, in terms of corporation tax, avoiding a big tax bill. And if you get to a certain level of income, it's also fairly easy to avoid if you could set yourself up as a company, for example, which many footballers have done. In terms of government spending, so once the government have got their money in tax revenue, where do they spend this money on? The big three are welfare, health services, the NHS, and education. In terms of welfare, you need to be careful on what welfare means. It's a very big, encompassing thing. So when people say welfare, most of welfare is taken up by pensions, but you've also got housing benefit, child benefit, in-work tax credits, which are a form of benefit, and unemployment benefit, job seekers allowance is actually only a very, very small proportion of it. So whilst welfare seems like this all-encompassing, dangerous term, it does actually include a lot of universal services to older people. The NHS and then education are the next one. So the NHS includes all of your GPs, hospitals, ambulance services, and education, obviously your primary schooling up to secondary schools. They're the big three. But then you've got far more spending on things like the judiciary, so the policing, courts, transport, housing, environment. There is a huge range of things that governments spend money on, but just in much lesser quantities than the top three. Also got to look at what type of spending it is from the government. So is it capital spending, which is investment perhaps in new infrastructure or new schools, things that are going to benefit us in the future? Is it a transfer, which is where you don't receive anything back? So that would be a pensions, that's a welfare payment. Or is it current day-to-day spending? So things like nurses, teachers' wages are current spending. You get something back for them, but it is in the current format. In terms of questions that might be asked or have been asked in the past, you want to be asking lots and lots of questions if the question is vague, which it almost certainly would be. So you might get a question along the lines of, is deficit reduction right? Or is how the government is reducing the deficit in terms of the mix between spending cuts and taxation correct? You need to be asking, well, it depends on what, as usual in economics. So if you're saying something government spending is going to be cut, you'll definitely want to know what is the spending going to be cut on. Is it health services? Is it the environment? Where is this going to have most impact, or where is the spending going to happen in terms of geographically? Is it going to be in London? Is it going to be in Newcastle? Is it going to be in Birmingham? Is it going to be in places that need it more? Your how long and extent arguments will also come in. So how long is this going to go on for? Originally in 2010, the government said the deficit would be sorted and we'd be back to a surplus by 2015. That was then extended to 2017. And in the last manifesto, which the government won, but without a majority, but in that last manifesto, they said austerity, i.e. spending cuts and tax increases, will go on to 2025. So how long is very important. And also how much. So how much is our education budget going to be cut by? How much is the NHS going to be cut by? So if there's a question on what is going to be cut, it is very, very important to get those evaluation marks to question where exactly these cuts are going to come from. You might also be asked, basically, is government spending good or bad? The question would be obviously worded in a different way, but the crux of the question when simplifying it would be, should the government have a greater role, lesser role? Is government spending, government intervention good or bad? And there are many pluses and minuses for this. Start with the negatives. If the government is spending money, they are obviously having to get this money from somewhere. So this might mean taxes are currently going up, or taxes will go up in the future. So if the government are spending more money now, they're either having to raise taxes, or in the future taxes will have to go up. The other way governments can get money, as I mentioned earlier, is government bonds. But government bonds are borrowed. You do have to pay them back, and you've got to pay them back with interest. So if you're going to use government bonds to fund your spending with government borrowing, then the interest payments are going to have to go up at some point, and that's obviously money then the government can't use on other things. When I was going through the taxes earlier, I was looking at incentives. I mentioned incentives, so that's another important thing to think about. If you are raising taxes, what effect is that having on the people's incentives to go to work or companies' incentives to invest? This is where the Laffer curve, which shows at what point does the rate of tax mean that people actually get a lower incentive to work or businesses get a lower incentive to invest, comes in. And a micro argument is the argument of government failure. So governments might be spending this money, however, are they the best? Is the market better at doing it? And the last downside is something we discussed a couple of weeks ago, crowding out. So if the government are spending money, does that mean that private firms won't spend money, or does that mean private firms won't be able to get the loans to spend their money? For the advantages, this you would link in your essays to the Keynesian arguments. Government spending is a very important tool in terms of aggregate demand management. So if we were on our flat bit of aggregate supply, if our AD curve was showing spare capacity, if we were in recession, it's very important that governments spend money to help us get out of that recession. So this is where the paradox of thrift comes in. If private individuals aren't spending money, then the government should. Otherwise, demand will collapse, because if everyone saves their money to pay off debts at the same time, you'll get negative multiplier effects, and that will mean that the recession would just get worse. I've also got to look at what the government is spending money on. So it could be on key industries or infrastructure. So arguments in the news at the moment about nationalising, bringing back into government hands things like railways or energy. That's because they're inelastic in demand, they're natural monopolies, so difficult to get competition in. And so the government could take a key role, but the key industries also could mean areas. So a couple of years ago, Bombardier Train Company in Derby was saved by the government. You've got Tata Steel in South Wales. Should the government save these things or help them subsidise, give them tax breaks to enable the local economy to grow and prosper? And the last big argument for government spending is again linked to what they spend it on. So if the government weren't there to provide public goods, things like parks, then these things may well not exist, or they may well wouldn't have universal access. Governments would also spend money on merit goods, so things that are good for us but are underprovided, and positive externalities. So you've got the fact that governments might be protecting key industries, they might be using it as a demand management tool whilst in a recession, or they might be spending this money on public merit and positive externalities. And the last thing is an advantage is to help with equality. So countries in Scandinavia that have got more distributive welfare systems, they might tax a bit higher but spend a bit more on services. This enables a more equitable split of resources in the country, which is of course one of the government's macro objectives. Okay, thank you for listening. That is all on fiscal policy for today.